Understanding bonds, bond prices, and bond yields? Stay tuned. I'm Priscilla Shumba, and this is Reinventing Perspectives. If you're interested in our financial literacy and financial terms series, do stay tuned and comment down below if you have any terms that you'd like us to take a look at. Well, a bond has got three components. A bond has got a face value, which doesn't change, and this is the value that is given by the issuer, whether it's a government or it's a company. For example, the face value of a bond can be 100,000. For now, let's just say 100. That's the face value of the bond. It doesn't change. Face value of the bond and the bond price are two different things. Then we've got the coupon rate. The coupon rate is the interest rates that the bond will earn the bond holder. A bond is a debt instrument. So in simple terms, the bond holder has given a loan to the bond issuer. So when we purchase the bond, we are making a loan to that government or to that company. In exchange for providing them with the loan, we require an interest rate, and that is our coupon rate. The coupon rate, which is the interest rate, is paid out at intervals. So it depends on the agreement, whether it's annually or semi-annually, whatever the specifics of the bond note. So for example, if the coupon rate is 10% and the bond face value is 100, so we know that 10% of 100 is 10. The coupon amount will be 10 per pre-agreed interval. Investors think in terms of risk and reward. So your bond is considered to be a low risk investment, but it's also considered to be low reward. Low risk because no matter what happens, you will still get your pre-agreed coupon rate, which is your interest. As compared to shares, where if the company is performing really well, the share price can skyrocket. And you could also get a great dividend. The company is also not doing very well, the share price may plummet and you may not get a dividend. It's not guaranteed that you'll get a dividend. It depends on a variety of factors. One, it can be that yes, the company is doing well, investment opportunities that the company is seeing. So instead of paying a dividend, they choose to invest in something that will greatly increase the value of your shares. It can also be that the company is not doing well, and therefore it doesn't make sense for them to pay a dividend where they could use that money, improve their financial situation. Therefore insulates the value of the company and therefore the value of their shares. So there are a lot of different reasons why a company might or might not pay a dividend. But when it comes to the bond, it's fixed, it's set. No matter what is going on, you will get your coupon rate. And at maturity of the bond, you will get your money back. Because remember, it's a loan, unless the company or the government defaults on the bond. So there's never really a complete 100% safe way to invest. There's no guarantees, but a bond is considered to be low risk. We've talked about the face value of the bond. Now let's talk about the bond price. The bond is sold into two markets. When the government or the company is issuing the bond for the first time, primary market, because it's going directly from bond issuer to the bond holder. And then the bond can be traded the secondary market, which is individual investors, organizations, people trading the bonds within themselves. In the secondary market, you can think of the bond like you would any other good. Forces of supply and demand are at play. If people demand more of a bond, it'll drive the price up. If people demand less of the bond, then it'll drive the price down. For example, let's say the economy is booming. The share market is where people are making a lot of returns. Investors will think about moving their money from the bond, which is low risk, but it's also low reward, and move it to shares where it's high risk, but they're also seeing that there's a high reward. In this way, the demand for bonds declines, and therefore the price of bonds also declines. On the other hand, if the economy is not doing so well, the share market is plummeting, investors will typically move their money from the shares which are high risk but high reward and move them to bonds where they're safer. So bonds are sometimes considered a safe haven for investors, but this isn't always true. Nothing in the investment world is really set because things are constantly changing and there are a variety of factors that are always at play in how investments can be valued. Now we can talk about the bond yield. The bond yield is considered the actual or the real return on a bond. Yield, remember, which is the real return, is equal to the coupon amount divided by the bond price as a percentage. So for example, if the bond price is 110, we know that the coupon amount, which we get from the coupon rate and the face value, which are fixed, we know that the coupon amount is 10. But now we know that the bond price, the price at which it's trading in the market, is 110. So the bond yield, which is the real return, would be 10 divided by 110. Real return is actually about 9%. Now let's think about it the other way. Let's say the bond price is gone down to 80. Okay, back to our formula, we would say the coupon amount, which is still, it's fixed, it's 10, divided by the bond price, which is 80. And then you'd get bond yield of 12.5%. So if you look at it this way, you see the relationship between the bond yield and the bond price. The relationship between the bond yield and the bond price is inverse. When the bond price is up, the bond yield is down. Price is down, the bond yield is up. Simply that if you're paying more for something than what it originally cost, obviously you're getting a lower return because you paid more for it. So if the bond price is up, the bond yield will be down. You can think of it in terms of that, like you would look at any other good. One last thing is sometimes you'll hear when they're giving financial news, they'll say bonds rose by XYZ or bonds fell by XYZ. They're often referring to the bond price and not the bond yield. Remember, the price is just like any other good, demand and supply. What are people willing to pay for it? How many people want it? How many bonds are out in the market, and how many people want or are moving away from bonds. Yield, remember, is our return, the actual return that we're actually getting from holding that bond. It's different from the coupon rate because the coupon rate is preset, but remember, when the secondary market, things are changing as the bond is trading and the economy is changing. When you hear them say bonds rose or bonds fell, you want to be asking yourself, well, why would the bond price rise? Or why would the bond price fall? Bond price rise isn't necessarily a good thing because it means that the actual return on the bond has fallen. Remember the inverse relationship between bond price and bond yield. Really, it's a starting point for you. When you understand the terms and you hear them being used, it's just a starting point for you to ask questions. Okay, well, if that is happening, what does it mean? What is actually happening in the economy? By the way, all information on bonds is actually public information. So you can go online and you can research and find out what exactly is going on in the bond market. But it's not possible for you to watch all the bonds because there's just so many bonds being issued at any one point in time. But what you can do is you can find out which is the benchmark bond for your country. And then you can keep track of that. So that when you hear that things are happening with that benchmark bond, it causes you to ask questions of, okay, well, what is really happening in the economy? As an entrepreneur, you always want to have your ears open to what's taking place in the economy. Financial news will give hints or tips to things happening before the actual mainstream media. As we always say at Reinventing Perspectives, the numbers are telling you a story. Don't avoid them. The element of surprise, we want to avoid that as much as possible as entrepreneurs. We always want to have a heads up of what exactly is going on and how would it impact us and impact our business. If you got any value out of this, please do subscribe, hit the like button, and share with somebody else. And if there's something that you'd want us to take a look at, leave a comment down below and let us know how we can serve you better. Until next time, stay well.